This diagram compares two starting investments of $100,000. On the left, that cash goes into the stock market. A 10% increase brings your total to $110,000, a $10,000 gain. On the right, that same $100,000 acts as a 10% deposit on a $1 million property, invested. Financial reports often compare property and stock returns using a single number, percentage price growth. When both are reported at 7%, they appear identical. However, this comparison ignores the effect of gearing, which drastically changes the outcome for the individual investor's capital. To find the actual return on your equity, you divide the property growth rate by your equity ratio. With a standard 70% mortgage, you hold 30% of the equity. A 7% market rise divided by that 30% stake results in a 23.33% real return on your cash. While traditional investors wait passively for market shifts, professional property investors use these ratios to manufacture higher returns from the same market movements. High-margin deals rarely survive the transition to public listing portals, where competition is highest. Professionals instead target off-market opportunities by identifying sellers facing financial or time distress, situations where the owner values a certain rapid exit over achieving the highest possible market price. Finding these anomalies requires an emotionless statistical pipeline called the 100-10-3-1 rule. You review 100 properties to calibrate your understanding of local value. You then submit offers on the 10 most promising deals, arrange finance for 3, and successfully close on the one that meets all your criteria. To increase the likelihood of acceptance, you can bypass traditional negotiations by attaching a physical, signed deposit check directly to your offer. For a motivated seller, the sight of a stapled check signals that you are a serious, liquid buyer who can solve their problem immediately. You also include the and/or nominee clause next to your name on the contract. This provides the legal flexibility to settle the property in a different entity, such as a trust or a company, without needing to renegotiate the terms of the deal. Adhering to this high-volume sourcing pipeline and using defensive contracting ensures that the profit is secured at the moment of purchase, rather than being dependent on future market luck. Forced appreciation is a targeted physical intervention used to increase an asset's value. By making specific improvements that the market rewards with higher rent or a better appraisal, you can create equity regardless of whether the broader economy is rising or falling. This process is governed by the capitalization rate formula. It states that a property's value is determined by its annual net income divided by the local cap rate. This means any action that increases the property's rental income creates a direct, multiplied increase in its total appraised value. For example, spending $1,000 on a carport might allow for a $20 weekly rent increase, or about $1,000 a year. A 10% cap rate, dividing that $1,000 income boost by 0.10, results in $10,000 in newly manufactured equity. Selling the property to access this equity triggers capital gains tax and ends the asset's ability to generate ongoing cash flow. Instead, you refinance. By taking out a new loan against the higher appraised value, you extract the equity as cash. Because this money is classified as a loan rather than income, it is non-taxable and can be redeployed into your next acquisition. You can further optimize this with artificial depreciation. The tax code allows you to claim a non-cash loss for the building's gradual wear and tear. This allows you to collect positive rental income in your bank account while reporting a legal loss on your tax return to offset other income. Forcing equity and extracting it through refinancing provides the capital needed to fund subsequent deposits, allowing the portfolio to expand using its own internal growth. While residential properties are effective for building initial equity, transitioning to commercial real estate allows for greater scale and more automated management. Commercial valuations are based strictly on income and long-term leases. These deals often utilize net leases, where the tenant is responsible for property outgoings, like insurance, maintenance, and rates, shifting the operational burden away from the owner. A mature portfolio requires minimal time when managed through professional property managers. By establishing clear communication protocols, the daily oversight of the assets is handled by dedicated specialists. Paying your contractors immediately upon the completion of a job helps you secure priority service. In competitive markets, being the client who pays the same day ensures that your properties are moved to the front of the queue when urgent repairs are needed. These valuation formulas and lending mechanics are consistent across many international markets. This allows you to follow the data and deploy capital in regions with the most favorable growth and yield, regardless of your personal geographic location. Success in real estate relies on a borderless application of these mathematical rules. By combining high-volume sourcing with the bank's willingness to lend against tangible collateral, you can build a predictable system for long-term wealth accumulation.